The stock market in 2025 and early 2026 is operating under immense pressure. Artificial intelligence has pushed valuations into the stratosphere, and just 7 tech giants now dominate the indices, creating massive market concentration. But while the crowd is buying, Aswath Damodaran is doing the opposite. As the Kirshner Family Chair in Finance Education at NYU Stern, widely known as the Dean of Valuation, he has spent the last 13 months quietly hoarding cash. His reasoning comes down to a strict dividing line between 2 concepts that most people treat as the exact same thing: price and value. Price is what the market is willing to pay right now, driven entirely by mood, momentum, and supply. Value is the actual intrinsic worth of a business, determined by its ability to generate future cash. When investors forget this distinction, they fall into one of 2 traps. On one side, they buy into fairy tales, hyped-up narratives completely disconnected from mathematical reality. On the other side, they build soulless spreadsheets, relying on dense grids of numbers that ignore how the business actually operates. To survive a market built on the bigger fool theory, the hope that someone else will always pay a higher price, an investor has to actively build a bridge between the qualitative story of a company and the hard quantitative data. Before we cross that bridge, a quick note. This video is for educational purposes and is not financial advice. Always do your own due diligence. And to help with that research, check out the Buffett Indicator iOS app to track market valuations in real time. The foundation of Damodaran's entire methodology is intrinsic valuation. To calculate it, he relies on the discounted cash flow, or DCF model. A DCF is a financial formula used to estimate an investment's worth, based on the money it is expected to generate in the future. An asset is worth the present value of its future cash, specifically free cash flow to the firm and free cash flow to equity. Discounting these future dollars back to the present accounts for the risk that those projected cash flows never materialize. The math itself is objective, but the entire engine breaks down and becomes useless if the future cash flow estimates you plug into it are based on a fairy tale. Damodaran runs narratives through the 3P test funnel to convert hype into a realistic DCF. First is possibility. A company's terminal growth rate can never exceed the economy's risk-free rate. Next is plausibility. Massive future growth claims require proof of correspondingly massive capital reinvestment. Finally, we reach probability. To measure the likelihood of success, Damodaran calculates the implied equity risk premium, or ERP. The ERP is the extra return investors demand for holding stocks instead of risk-free government bonds. Rather than relying on flawed historical averages, he uses current stock prices and expected future cash flows to give a real-time, forward-looking measure of market risk. By forcing every claim through this framework, the analyst strips away market delusion. Subjective feelings about a brand's dominance are translated into undeniable mathematical constraints. This discipline is tested severely by the dark side of valuation: young, money-losing idea companies that have massive public attention but zero historical data. To adapt his framework for firms with no past, he models their required reinvestment using a sales-to-capital ratio, a metric measuring how many dollars of revenue a firm generates per invested dollar. Because early-stage failure is extremely common, he applies a strict survival probability discount to the final value, mathematically accounting for the chance the business goes to zero. It doesn't matter how disruptive the technology is. Eventually, even the most unpredictable, hype-driven startups must bow to the laws of economic gravity. This scale illustrates Damodaran's assessment of the entire S&P 500 in early 2026. By applying his framework to the broad market, he calculated an implied expected return of 8.91%, concluding the market index was roughly 12% overvalued. But finding a valuation is only half the job. Acting on it is the other. Despite his complex math, Damodaran's personal approach to managing his wealth is deeply pragmatic, prioritizing strict behavioral discipline over constant tweaking. He maintains a portfolio of 100% equities and holds absolutely zero bonds, aiming for the higher historical risk premium of stocks. To protect himself from his own success, he uses ruthless rules for trimming his winning positions, actively selling off shares when a single stock grows too large to avoid dangerous portfolio concentration. So when he spent 2025 and early 2026 hoarding cash, he wasn't trying to blindly time the market. It was a mechanical response. His models showed a lack of intrinsic value, so he simply waited. The true power of this methodology isn't that it provides a crystal ball for predicting the future. It acts as a shield, forcing you into disciplined personal action precisely when the rest of the market is manic. In a financial era defined by artificial intelligence hype and data overload, Damodaran teaches one final truth. There are no precise valuations. The goal is to be approximately right, rather than precisely wrong. True investing requires the pursuit of a price justified by future economic reality, completely ignoring the fleeting emotional perceptions of the present. To continue building your own analytical frameworks, subscribe to deepvalues.ai for multi-agent intelligence tools. Be sure to check out our sister channel at Deep Values and like this video to support the channel.